So he's sort of, Kristen, taking the temperature of where we are. What about the reality check, as he says, and how we need to figure out what the multiple is? And that all depends what earnings are going to be. And we're not going to know for a little bit here, but they're kind of right in front of us.
Yeah, so I think I agree with those comments in terms of we're in a different reality. We're in a different market where it's going to be harder to be profitable, where it's going to be more challenging. That being said, I think the main question that's on everyone's mind right now is going back to the Fed in the driver's seat and rates being a critical part of this equation. The questions were how high, how fast, and for how long? And the first two questions, we largely have the answers to. The how long is really the question that everyone is debating, and how that's going to flow through into the consumer spending patterns, into corporate earnings. And so I think that's the major question on the table.
The other thing I love is, look, he's made a lot of money and it's worth a lot of money, but he's just like everybody else. He's looking for yield in the safest place that you can find it, and he gets it in a CD. So he's going to park some cash there and figure it out. But it underscores the fact, Mike, there's still competition. There's a lot of competition to equities in a way that there just hasn't been in the last many years.
There's a psychological hurdle rate, I would put it that way, for individuals or institutions who feel as if they're targeting a specific number that they're comfortable with. Yeah, absolutely. You don't have to stretch to grab risk to lock some of that in. We could talk about what a more efficient portfolio looks like over time and everything. And by the way, the logic also applied at the beginning of this year when you could have gotten your 5%-ish in money market funds. And if you're happy with that, you're great. The S&P 500 is up more than twice that.
Sure.
So you have to understand what the opportunity cost is in certain types of environments. And honestly, I think if the S&P is going to earn 240 in the next 12 months, right? That's what the consensus is. A lot of questions around that. I think the market is probably insulated against a huge downdraft. Usually it finds its way if earnings are growing.
That earnings number is going to be
so that's
right,
why the multiple you have to argue about both sides. But
Yeah.
I think that the multiple again is one part of the equation. But if earnings come through, I think it's hard to think that it's going to be a disaster.
Hey, he'd be the first one to say that, and he sort of alluded to that.
It's a big question.
If you believe, Kristen, some of the numbers that are out there from Goldman and otherwise, and we can put up, if we have guys in the back, where earnings growth projections are, right? You get a little tick higher finally in this quarter, and then 24, they start to really edge up. There it is. If these are right, then we're probably good. If they're not, bigger questions, especially relative to where rates are.
I think they look a little rosy for 2024. I think this is something that, do we see earnings growth in 2024? Absolutely. Is it that high if we're in a higher for longer regime? I think that's going to be challenging. So while earnings certainly have troughed here, the growth trajectory from here, I think, is going to be more modest. I think one good news, though, is when you look at the fact that all this talk about the contraction and recession, I think the fact that the profits recession is behind us is something certainly that's good for risk assets. It's just how much upside are you anticipating from here over the next 12 months?